then you know you need to get $60,000 in ground rent in order to be able to place that $60,000 ground rent on the market. And someone, you're going to offer at a 6 cap, someone's going to pay you $1 million for that ground lease. So that's how you get $1 million for your piece of land, where you may not have, you may not get that $1 million for a while by sitting there waiting for someone to come buy it for $1 million. But if you can get that Dunkin' Donuts lease, well, now you can sell it like that. As soon as they're on and that income stream is there, someone's going to pay you $1 million for that.
What is up, and welcome back to How to Invest in Commercial Real Estate. And we have an awesome show today. Before we get into it, we're gonna do a quick update, which I like. It feels like it's been a minute since we've recorded an episode.
Yeah.
I mean, it hasn't. We kind of booked a couple in advance,
so you guys could go out of it on vacation.
And
without me.
Yeah, Braden, you were in Aspen.
I was in Aspen.
Nice.
That was a ton of fun.
And I was in Mexico. That's why I'm tanner than you guys.
I did notice that. A little bit of tan. This guy got a free room upgrade.
Yeah, that was sweet.
That was
literally.
That was ridiculous. Yeah. But anyway, this year and really kind of the last couple months has been insane in terms of deal flow. And I know for like the last 4 months, we've been working on a lot of land acquisitions to do several developments, which are coming up. I know we've got a learning experience in Burleson coming up. I know we're about to break ground on our learning experience in Princeton. We have a learning experience in Riverside. So those three, we've got a Black Bear Diner and a Costa Vida in Fort Worth that we're building, and then another little strip center in Owasso that we're building. So on the development side, what is that? 5 developments probably going to launch in the first quarter.
But we got one closing tomorrow.
One closing tomorrow. Yeah, that's the Callaway's Nursery in Houston. We were supposed to close on that last month, but a lender literally retraded us at the closing table. So we were just like, screw you guys. We'll find another. I hate that, by the way. Like at the closing table.
That's a one-way ticket for me to never use you at all.
Yeah, and they were basically like, hey, we'll close today, but we'll fund after you meet these conditions. And we were just like,
hell you will.
Pass. We'll find somebody else. So we did. So we're closing that today, tomorrow. Yep. Feel really good about that. February 8th is the Jacksonville Starbucks build-to-suit. That one got delayed for very similar reasons, credit union kind of kicking it around, but we have full loan approval on that. So we are closing on that February 8th. Both of those deals have already been fundraised. If you're involved on both of those deals, be on the lookout for some information. We'll send an announcement out when we close and everything like that. But yeah, so 2 closings coming up in the next week, right? We've got 5 developments that we're going to be funding, all, plus or minus $1 million equity raise. Those will come out. In the next 6 to 8 weeks, we'll start launching deals. Super exciting. Those $1 million checks typically sell out very fast. As always, if you're on the sidelines and listening right now and saying, hey, how do I get involved in the next Criterion development deal? Don't wait until it launches.
Email us.
Yeah.
Shoot us an email. We'll get you on the waiting list.
Ahead of time.
Yeah, we'll plug you in before we even launch it, just to make sure we get you a spot. So send us that information now.
But some exciting news for 2024 is we're seeing a little bit of transition in our strategy back to cash flowing assets. And we're super excited about those. We've got a huge gas station deal that'll be a massive equity raise that'll take all hands on deck to get done. And then we have 3 or 4 shopping centers that we are about to get under contract. And you may say, well, you guys didn't buy many shopping centers last year. You did a bunch of development deals. Why are you doing shopping centers now? And so I just wanted to give a little bit of color on that. Like we've talked about, we used to buy around 8.5 cap. We get debt at 4. That spread allowed us to get all the returns the investors needed to invest with us. But as rates went from 4 to 7, now those 8.5 cap rate deals are not really a great deal to get the cash on cash yields we wanted. So over the last year, though, there would be a seller here that needs to sell, a seller there that needs to sell, and it starts to push those cap rates up. So now those same 8.5 cap deals are now 9, 9.5, even pushing 10.
And guys, these are the same properties we were offering on 9 months ago, some of them, right? Yeah. And they've still sat in the market, and we're getting the calls. Hey, do you remember that shopping center? Are you still interested at all?
Yeah. And what we didn't want to do before is buy at an 8.5 cap, borrow at a 6.5, 7, because we didn't actually know where rates were going. And if rates keep going up, that means the value of the properties in the short term is going to go down. And so what we've got a situation now is we think prices have come down, meaning the cap rates have gone up, but we think rates have stabilized. Yeah. So now we don't think there's any more rate increases in the near future, which will not devalue the properties further. But we do see in this year probably 2 to 4 different rate cuts by the feds. So those rates coming back down are going to start pushing prices back up. So we want to make sure we're in front of that curve, right? And we, normally we get debt that we can pay off whenever we want. And so we're going to buy at 9.5 cap, maybe 10 cap, put 6.5 cap debt on it. So there's still a spread, and we think we can still cash flow. But as the rates come down over the next year to 2, right, we can refinance, and then we're really going to be in the money. So that's why you're seeing a slight shift in our strategy with some of these existing shopping centers.
I would say there's also a big common theme. I mean, the refi is not the only value we're adding. I would say there's a big theme of us buying out parcels or properties with excess land or properties with existing out parcels. And we think we can split those off very fast, even in today's market, right, to reduce our basis and the remaining space, similar to what we did on the Plaza West deal, right, where we can return a portion of the equity or all of the equity and keep 50 or 100,000 square feet. A lot of these properties we're looking at have that possibility.
So you said out parcels. So are any of those out parcels on ground leases?
Some of them are on ground leases, but before we get into that, there's several deals. So we have one, two, three. We have 4 deals that will be in contract in the next week or two. Right, 4 deals each that have an equity raise of $1.5 million to $3.5 million.
And what kind of deals are those, for instance? Not specific names, maybe, but what
multi-tenant shopping centers and decent locations.
Yep.
Yeah.
A lot of them with out parcels,
Right.
Which I love. I think
I think it's important to say that our strategy isn't to buy now and then hope that the interest rates are going down. We're buying quality projects right now that pay and have a high IRR right now as they are.
Yeah, it's also a very interesting note. A lot of times we're doing 506 B. I think it's 506B, right? Where we can take non-accredited and accredited, but we just can't advertise it, right? That's why we can only offer these investments to our investor list, which if you're not on the investor list, go to the website, hit join our investor list, sign up for that. That's how you get these offerings. But we have so many deals under contract right now because we've been approached by so many equity brokers saying, hey, can I raise equity for you guys? Can I help fund your deals? Yada, yada, yada. And our deals have just been selling out so fast, we haven't had enough deal flow. So we're going after a ton of deals right now, a ton of deals. If everything closes that we're looking at, just in the first quarter, we'll raise right about $20 million, right? $20 million.
That's crazy. And I want to take a second just to give a shout out to our Fort Worth office and Andy, who is doing an awesome job, both finding equity sources, but also helping the deal flow pipeline. So he's doing an amazing job. He can't always be here on the podcast with us, but he's a big part of what we're doing.
Yeah, so absolutely, Andy and Russell both, and a lot of our joint venture partnerships, a lot of these seeds that we planted over the past couple of years are really becoming amazing. But anyway, because we're doing so many deals, so much deal flow, we're raising so much capital. The next few offerings might be accredited only because we're starting to advertise some of these deals. So, like the gas stations we're acquiring, that's a $12 million equity raise. So 99% sure that will advertise that one, and you'll have to be an accredited investor to do that. And all that means is you have to say you're an accredited investor, right? You fill out a form. If a checkbox is applicable to you, done.
I'm not sure, actually, they can just say they're accredited.
Yeah,
there has to be some due diligence on our side.
They're allowed to self-accredit themselves under 506C. It's a fact.
Okay.
Yep. Anyway, so just know if you're in and you see you are not a accredited investor, you may not be in that offering. But like I said, we have so many deals. There will definitely be one open for non-accredited investors. So don't worry, you're not going to be excluded.
There's plenty of deals coming up.
Plenty of deals coming up. So many deals coming up. Anyway, we are super busy. We're going to have an amazing first quarter. We're going to have an amazing second quarter. We've got a ton of developments that we funded last year that are starting to finish up. I know we're getting LOIs on some of the developments that are on the market, so be on the lookout for more information on those forthcoming. But without further ado, today's topic is ground leases. All about ground leases, why people ground lease, and kind of more information on ground leases because it can be confusing. It was confusing to me before I got into it.
We've only done a couple, right? Style and Go in Owasso, is that right?
Yeah, we've done a Salad and Go in Owasso. We've done a Salad and Go and 7 Brew in Princeton. We've done
A couple in Wichita, Wendy's.
Yeah, we did one in Burleson to Hawaiian Brothers, I believe.
Yeah, it's more
I've done Dutch Brothers.
Yeah, Wendy's, Wichita.
Okay.
But yeah, decent amount.
Yeah.
So, Brian, in essence, what is a ground lease?
Well, ground lease would be an agreement between a landowner and a developer where the developer agrees to pay a certain rent to the landowner to make improvements on the land.
Yeah, and
Agree with that?
Yeah, I mean, I think it's even more broad than you don't have to be a developer, right?
True.
Literally, a land lease can be for any use. Now, in the terms of what we're talking about, we're thinking commercial real estate and retail real estate. So yeah, most likely it would be a big retailer or a developer.
Right.
Yeah, but there's hunting land leases, right, where you have the right to go on and hunt on the land. There's
true.
farming land leases where you have the right to put cattle on there. You have the right to hay land. So
Mobile homes, the right to put your mobile home on
Yeah,
some
good
land.
point.
100%. So there's leases for land for a variety of things, and just like most leases or purchase contracts, you can restrict them any number of ways in that lease. Like, hey, I'll lease this land to shoot deer. Hey, I'll lease this land to put a shack that sells salads or coffee or whatever that is.
Yeah, it's just like the retail shopping centers we have. When a tenant comes to me and they say, "Hey, I want to sell smoothies," that does not mean they get the right to sell furniture. Like we restrict the use for retailers, just like you can restrict the use of the land when you're providing a land lease.
So would you actually put that in the lease that you're really only allowed to sell smoothies?
Only if you're smart.
Yeah.
You would do that. Otherwise, you open yourself up to not know what's going to happen.
They can do anything with it.
So you always want to restrict the use because it gives you as the landlord more flexibility and the tenant less flexibility.
Yeah, you can put it in the deed as well. You can put a deed restriction on there. You can really restrict it. I know at our property at 96th and Garnett, we're doing several developments there. Dunkin' Donuts is like a block down the road, and they have an exclusive use for coffee for all of the commercial land around it, which is not uncommon.
Which means they were early in the process.
Correct. They were early, and they paid a hefty rent to be able to get that exclusive. And retailers like this aren't, they've been known to sell these exclusives, right, to another user. So Starbucks could come a few years down the road and say, hey, Dunkin', I'll pay you $250,000 if you drop that exclusive and let me, go over here. And they still have to do a deal with the landowner. They're just paying off the exclusive, right? So it's very interesting.
Yeah, it's smart for Dunkin' to do that. It's not so smart for the for the landowner to do that. He's really limiting himself. And once again, Dunkin', you say they can sell that to Starbucks later because they're probably going to both be able to coexist on that same corner. But that's something the landlord could have made additional money on, but he gave that right up when he gave that exclusive.
So it's all leverage, right? Yeah. He either got more money for it or nobody was looking at it and Dunkin' was the only one. Yeah. I mean, there's something there, but retailers are going to ask for everything, right? And if you don't know to say no or at least try, I mean.
So that's what I was going to ask. What are the reasons that a landowner would do a ground lease instead of selling it? And what are the reasons that the developer would not buy the dirt, let's say?
Yeah,
we'll start with the landowner, I suppose.
All right, landowner.
Yeah, the first one is they're not a seller, right? Think about how many people you'd know. Like there's a guy locally, Bumgarner. That guy doesn't sell anything. He's never sold anything. He'll ground lease the shit out of a ton of stuff. He'll develop some stuff, but he's just like, I don't know if he's ever sold something in Tulsa, right? So there's people who are just not sellers. They're real estate collectors. They're going to pass it down generations and generations, right. Whatever it is. It's an amazing piece of land. They're never going to sell it. Think of Utica Square.
Yeah,
things never going to be sold.
Yeah.
Yeah, as an owner, I think it's a great option because what you get to do is you get to make money off the land, but while you own the land, just like any other commercial real estate, you get a benefit of appreciation over time. Mm-hmm. And so, you have this land, it's in a great location, and you can sell it for $2 million. But, 30 years from now, that could be worth $6 million. Mm-hmm. And so the ground lease allows you to monetize that value today, but also retain the value for the future. Yeah. And so that's a huge benefit. In addition, depending on the ground lease, is that if you ground lease it and they put some awesome building on it, mm-hmm. You limit the time they get to have that ground lease. When that ground lease expires, all those improvements stay with the land. So if they're going to put something that is valuable or increase the value of the land because of the building they're going to put on it, then you've increased the value of your land while getting income. So there's a lot of benefits for a landlord.
Go ahead.
It's not taxable, right? So like the rent you get is taxable, but it's maybe 5, 7, 8% of what you would get on a sale price. So you're paying the taxes over a longer period of time. Once the tenant goes in and you have that lease, you have the ability to leverage it up, right? Because of that lease and the improvements of the tenant and the cash flow that it's producing, you could leverage it up and pull out the money tax free that the sale would produce anyway, and then reinvest that money, right? That's an amazing pro. For the landowner.
Yeah, leasing land seems really easy, right? Compared to leasing your house or something like that. I mean, there's almost nothing that you have to do, right, to land.
And okay, so not always, right? I've seen a ton of ground leases. Sometimes it's turnkey. Hey, I'll take it as is. Sometimes it's pour all my concrete, put the landscaping in, deliver utilities, stub it up to the pad. Sometimes it's just grade the site.
Okay.
There's a lot of different types. And when you look at that, you said easy, and I think that's the big word here. When you're looking at a build to suit or some of these other options for a tenant to come in, there's risk associated with that because they may want you to invest $5 million in a building that they want leased back to them, right? Oh, yeah. A piece of land that you already own and you're not doing anything to it, or you're getting a dozer out there and scraping the grass and making it level, that's a substantially less risky position to be in than building you a building hoping you pay for it. Like the rent you're going to have to pay me for a building is just obviously more than just the land.
Yeah. So if you're a landlord and you're saying, hey, I'm just going to lease the ground and they have to spend all the money on the building, easy and virtually risk-free for the landowner.
Yeah.
But then what Braden was mentioning, and we'll describe what is a build-to-suit. Well, it's when, let's say, a retailer says, hey, I'll lease the ground for a higher number, but you have to build me the building that I want, cost-wise. Now, of course, as the owner of that ground lease, eventually you'll get that building back. But if you spend $2 million building them a building and then they default on that lease, you just spent $2 million and you're not getting any rent until you can release it.
Okay, under that idea, so the ground lease and the building lease are all tied up together and you're leasing it for one amount, or you're leasing the land and then they get a loan and they pay you back for the building? How does that work?
Yeah, they're separate.
Not necessarily.
If it's a build to suit, it's all tied in, right? Like if you're doing a build to suit, it's one number. I'm building a building on the land. You pay to rent the building on the land. If it's a land lease, then you're just paying me for the land. You worry about the building. A lot of the times the tenant will finance that as well, or build it in cash and then finance it after it's done. There's various number of ways they could do it, but the general idea is on a land lease, they're doing everything improvements wise, or 90% of it improvements wise, once they have the land. Right, a build to suit, right. You're doing all of the improvements, and then you're leasing back all of the improvements on the land to them.
Okay,
did that answer the question?
Yeah. So
we talked about what's beneficial for the landlord.
So I was going to say, what's the benefit for the developer or the tenant? Why would they want to lease land instead of buying the land?
Well,
several reasons. Go ahead.
Yeah, very similar to the owner not having a taxable event for millions of dollars and just getting a portion of that. They're not having to outlay millions of dollars to pay you for the land. They're just paying you a small portion every single year in exchange to lease that, right? And then typically they're handling their own improvements, and they're leveraging those as well, right? They'll go get a loan from a bank to build the building on top of the ground lease that they're paying us.
Yeah, so to be more specific, let's say you're a retailer and you want to be at this prime location and the land is really expensive. Well, okay, if you buy that land, let's say it's a $2 million piece of land, you may get a 60, 70% loan on that land. So now you got to come up with 30%, 40%, $600,000 to buy that. Well, companies that are in rapid expansion like Dunkin' and Starbucks, and they're trying to open thousands of stores worldwide. And so each time they have to put that much money down means they can't open another store. Yeah. And their stock price depends on how many stores they can produce and how much revenue they can generate from those. And so they really don't want to put out any money. And so the best way for them to do that is to lease the ground. That way they're out no money on the land. And then they get a loan on the building, and usually if the land is already taken care of, they can almost get 100% financing on that building. And now they're almost in no money, and they can open these stores without any outlay of money.
Okay.
Yeah, so let's talk about a Starbucks, right? Big round number, a Starbucks is $1.5 million, $2 million for the improvements, not the land. So when you think about that, Starbucks has hundreds and thousands, hundreds worth, like thousands and thousands of locations.
Yep.
They have tons of locations, right? If they had $1.5 million on their balance sheet for every single location, the amount of equity they would need to grow would be huge. It would be absolutely massive, right? And also, when you look at the margins of these retailers, right, like a chicken place, a smoothie place, a coffee place, whatever it is, they're trying to get, 20, 30% plus net margin on their volume, their sales, right, their revenue. We're not getting that in real estate. We're not getting that as real estate investors. Typically by owning the real estate, unleveraged, that thing's making 6 or 7% in cash. They're making triple that by selling coffee, chicken, smoothies, haircuts, whatever it is. So it's not a good business decision for these people to own real estate. It's not fast for them to own real estate. You see it in companies that just want to be super safe, either that or that are massive, right? Like Target. Target owns a lot of real estate, right? Walmart owns a lot of real estate. But I've seen a Target, I've seen a Home Depot on a ground lease.
Oh, for sure.
100%.
Yeah. And another benefit for these big retailers is you can't depreciate the land.
Oh, that's
so
cool.
The more money they have tied up in non-depreciable assets increases the taxes they have to pay on their profits. And once they pay those taxes, they can never get that money back. And so what they want to set up is a situation where they can grow really fast, not outlay cash, use that cash for operations and growth, and then get themselves in the best tax position possible. And so by leasing the land, that lease payment is 100% deductible, or able to write off against their income.
Is it harder for, let's say somebody wants to build a building and they have a land lease, is it harder to get a loan because you don't own the land, you only own the building? And what happens if they default on the loan to the bank?
Great questions.
It can be more difficult. I think this is where you get into the subordinated versus non-subordinated ground leases. It's going to be deal by deal basis. It's going to be how the tenant is financing the building. I think on like a Salad and Go or a Seven Brew or a Dutch Brothers, right, where you're delivering a pad with utilities most likely, and they're essentially setting a modular building on that. Those are probably non-subordinated in the sense that they're not leveraging those up, or if they are, it's such a little loan balance that they're not worried about getting the entire thing as collateral. I would think the bigger the deal gets or the worse credit the tenant has, that's when you start getting into where they want it subordinated and they want the right to, I guess, be in first position over you as the landowner, which, obviously is not ideal. It just comes down to the leverage in the situation, I guess, how bad you need that deal and what the credit of the tenant looks like.
And it's a good question because I'm not sure that I'm educated enough to answer exactly how the loan differs, because I've never purchased a building that was on a ground lease. It's a much different, much more complicated evaluation to buy a building that is on a ground lease. And let's say you pay $5 million for this building that is subject to a ground lease. So now you're getting rent, but you only have 15 years or 10 years left on that ground lease. So when that time's up, your building, if they don't extend that ground lease, they take that building. You have nothing. You don't own the land. You don't own the building. You don't own anything. And so you really have to evaluate exactly how to maximize profit there. And that's why a property subject to a ground lease is going to be and must be on a higher return profile. Because at the end of it, you're working your way to zero. Where on the flip side, you're buying fee simple, where you own the land and the building. At the end, 10 years, 20 years from now, you still own the land and the building, and that has gone up in value due to inflation. Where if you're subject to a ground lease that may not have any extensions, you're working your way down to a property that's worth zero. Because that landlord, if he doesn't extend that ground lease, he just takes it.
And you're talking about, I just want to be clear, you're talking about buying a building that's subject to a ground lease, not buying a ground lease that has a building on it.
Yeah, that's right.
They're very distinct things. Buying a ground lease that has a building on it is the inverse relationship, right? When that lease expires, you have all of the leverage because you own their improvements. You can just say, hey, pound sand, it's double. Right? Or whatever it is.
You have total control.
That being said, Brian and I were kind of chatting about this while you were in the bathroom. A Salad and Go or a Seven Brew or something like that, they're probably penciling in the cost of their improvements over the initial lease term. So they're probably not that Like they're probably not hurting that much. If there's a location right across the street, we see Starbucks do this all the time. Like the Quick Trip, we see a lot of these people do it all the time. They'll just move right across the street. Hey, it's a little bit of better location, or it's not a worse location and I can get cheaper rent, whatever it is.
Yeah.
What else?
What about if you own some property? How do you evaluate the lease rate? Is it just like if you own a multi-tenant property and it's based on credit worthiness and location? I mean, is it really similar on what you charge?
There's a calculation. Let's just say you own an acre of land and you want $1 million for it. Does that sound good? Mm-hmm. You want $1 million out of the acre of land. Somebody says, hey, I want to ground lease this piece of land. You still probably want $1 million. You're just trying to get $1 million out of it. But instead of selling a raw piece of land for $1 million, you're selling a ground lease worth $1 million. Mm-hmm. So what you do is you get a broker's opinion of value, a BOV, on what we think a ground lease for that tenant or that credit worthiness would sell for on the open market. And you need to do this before you sign a lease, because they're going to tell you, hey, if you get it around this rent, or if the total cost is this much, or the credit worthiness or the lease term, all of these things are big things when you're negotiating it. But they'll say, hey, if you get a 15-year lease and $100,000, I can sell that for a 6 cap, right? So then you just go to your calculator.
Already did it. $60,000
on a 6 cap.
Yep.
Son of a gun. $60,000.
That's good.
Wait. $100,000.
60,000 divided by a 6 cap is $1 million.
Oh, okay. $60,000 is on a 6 cap is $1 million.
So if you want $1 million for that, and you've got it, let's say a Dunkin' Donuts, and they're selling on a 6 cap on the open market, then you need to get $60,000 in ground rent in order to be able to place that $60,000 ground rent on the market. And you're going to offer at a 6 cap, someone's going to pay you $1 million for that ground lease. So that's how you get $1 million for your piece of land, where you may not get that $1 million for a while by sitting there waiting for someone to come buy it for $1 million. But if you can get that Dunkin' Donuts lease, well, now you can sell it like that. As soon as they're on and that income stream is there, someone's going to pay you $1 million for that.
Because they didn't buy a piece of land. I want to make that clear. They bought a piece of revenue, and they got a piece of land for free. Yeah, right? That's how they're looking at this. And man, there was something else I was going to say and forgot about it. Another pro, right, is a lot of the times the value on the open market from the lease is worth more than the raw land. So don't sell yourself short. If you want $1 million for a piece of raw land, that may be $1.5 million for that ground lease, right? Mm-hmm. You're playing the game, right? And if you have a piece of land that you're interested in ground leasing, or you see ground leases next to you, call brokers, ask about rates. Hey, how much are you paying for this? What did you get this deal done at? I mean, I think people forget to negotiate sometimes and just think like, oh my God, I get an LOI from Chipotle, I have to take it. Yeah. You don't, right?
Yeah, you got to evaluate all the options. And we have a piece of land on the market right now that we're trying to get a ground lease on, and we haven't done that yet. But just going back to the Vegas example where I had this piece of parking lot, and we could have sold the piece of parking lot for maybe $500,000. It was less. It was like a half an acre.
See, now you said it's half an acre.
What'd you say with
freaking hilarious. No, last time I said it was half an acre, you're like, oh, no, it's an acre. We're going to pull this shit up and overdub it now. He said it's half an acre. It's definitely an acre. I know now.
I don't know what it is. But in any event, we probably could have gotten $20 a foot for whatever size it was, okay?
Yeah.
And we got Dutch Brothers on the hook on a 10 or 15-year lease at $65,000. And the great thing about that is they're pretty hot in the market out there. And so we didn't sell it for a 6. We sold it for like a 4.25. And so 65,000 divided by 0.0425 is 1.529 million.
Wow.
So it literally,
and $20 a foot on an acre is 871,000. Yeah, so it's almost double.
So we almost sold it for $40 a foot, all because we did a little bit of extra work, got a great credit tenant on there with some ground lease rent. And now, boom, we got double the amount that we could have just sold the raw land for.
Yeah.
That's the power of a ground lease.
So I just love them because they're super easy. They're way easier than a build to suit. You don't have to build them anything. You don't have to vet construction companies. You don't have to draw a building. You don't have to. It's just so much easier to sell a ground lease. To build like everything about a ground lease is easier initially, from my experience.
Yeah. So, I know there's a lot of nuances we didn't cover with regards to a ground lease, but, we're already pushing, kind of the limit for what we like to put on the show. So if you have questions about ground leases, you can email us and we'll help you find the answers. We may not know them, or you can use the internet and find the answers yourself. Yeah. There's a ton of information online, but it is an effective tool to selling real estate or to maximizing the value of that real estate. So if you own a piece of land, if you think you have access to a piece of land and you want to explore that, ground lease might be a good option for you.
Yeah. And just to circle back, right? Like we've got 9 or 10 deals literally, under contract that we're trying to fund that should all close this quarter, right? So 10, 3 months. Wow. I mean, we're already done with the first month. So, I mean, the next 90 days is going to be insane. If you're not on the investor list, join now. If you are on the investor list, watch your email. There's going to be deals popping out. Don't get FOMO. There's going to be a ton of deals, right? We're going to get everyone involved. If you've got friends that want to get involved, now's the time. Colleagues, now's the time. So, yeah, we're excited. A lot of deal flow.
All right, guys, thanks. Until next time,
see ya.
How to Invest in Commercial Real Estate.